So we were discussing the chapter number 8, project appraisal. So in the last class we did with the IRR. Okay, so what is the IRR and how to calculate the IRR, and how can we take business decision by using the different calculations like payback period, ARR, NPV, and IRR. So the next topic is weighted average cost of capital. Okay, weighted average cost of capital. So what is the weighted average cost of capital? So weighted average also called WACC, WACC, WACC. So in the short form, it's called WACC, WACC. So what is the WACC? So when a company raises finance for expansion or for a capital project, there are costs associated with these funds. The project or project under consideration must be able to make a return that is at least equal to this cost and this cost of capital. For example, the project which we are going to operate, their return must be matched with this WACC, or you can say project return must be equal with WACC. Otherwise, there will be no return for the shareholder. As such, it represents the minimum return that is acceptable. So WACC is the minimum acceptable minimum acceptable return. So in short form, WACC represent minimum acceptable return from an investing activity, from an investment. Okay, now how to calculate WACC? So the formula WACC in this stage, it's not the complete one. Cost of interest and return divided by total cost of the project into 100. So this is the weighted average cost of capital. Okay, so total interest and return divided by total cost of the project. Okay, so this is the formula. So remember this formula, memorize this formula. Yes, hope so you get the formula. So WACC is the cost of interest and return divided by total cost of the project into 100. Okay. Now here is the work example. Global Digital Construction Public Limited has been offered a large contract to develop telecommunication infrastructure for a government. The contract is worth 950 million. So this is the contract cost, $950 million. So we need $950 million. We need $950 million to develop this telecommunication infrastructure. How to manage $950 million? So the proposed funding for the project is, so ordinary share, we will arrange the fund by using the 300 million ordinary share, 90 million by preference share, by issuing 410 by issuing the debentures, and 150 we will obtain loan from bank. So that's for that we are able to manage the fund. Okay, so when you total it, so the total will be the 950 million pound. So 950 million pound we can arrange by issuing the ordinary share, preference share, by issuing the debenture is a loan certificate, and 150 we will take loan from bank. Interest rate, expected return, interest rate 5%, 3.5%, 8%, 4.75%. We will uh, we will be charged, okay, or we will pay this interest rate. You have been asked to calculate the weighted average cost of capital. Okay, so for the weighted average cost of capital, so for the ordinary share, expected return with 5%, that is the 15 million 90. 300 multiplied by 5.5 is equal to 15. 90 multiplied by 3.5% is equal to 3.15. 410 into 8%, that is the 32.8. 150 multiplied by 4.75%, that is the 7.12. And the total will be the interest and return will be the 58.07. And the total cost of the project is the 950. So we just do this 58.075 divided by 950 multiplied by 100. So 6.11 is our WACC. So this is our WACC, weighted average cost of capital. Okay. So because we have to pay 6.1111 because we arrange fund and we have to manage the 6.11% investment. Okay, 6.11% interest we have to pay this. Okay, so we have to find the project that will give us more than 6.11%. Okay, so this cost of capital is sometimes referred to as the hurdle rate. It is the minimum rate of return that must be achieved from an investment for it to be profitable. Okay, so this is the calculation of the WACC. So interest, cost of interest, interest divided by total cost of project. Yes, got it. Got this point. Okay, now this is the activity. Case study, Global Digital Construction Limited. Okay, so now you can take this activity as a homework. So this is a simple one. So this is the arrangement of funds. So this is the arrangement of funds, and these are the interest rate, expected returns, and you have to calculate the WACC. Select the most appropriate funding option for the director of Global Digital Corporation, giving one reason for your funding choice. So which funding choice is most appropriate? Okay, so you have to discuss. Okay, so for the answer number two, so to obtain bank loan uh, is the good one because we will be charged only 5%, and preference share, we will issue the preference shares only at 3%. Okay, so the next will be the profitability index. So what is the profitability index? Profitability index, the profitability index is a measure of acceptability of a capital project. So either we accept the capital project or not. It compares the initial investment of a project with the net present value of future cash flows. So how to calculate profitability index and how it's relate either the project is favorable or not. For example, if the profitability index greater than 0, it's mean project is favorable, or profitable. Okay, so if the profitability index is equal to 0, then the project is neutral. It just only cover the cost. And if the profitability index less than the 0, so greater than 0 is the positive, less than mean negative, so in that case project is not profitable. Okay, so now how to calculate the profitability index? So present value, net present value divided by initial investment. So this is so simple. Okay, so we know that how to calculate the present value, we know that, and initial investment always be given in the question. Let's see the example. Work example, this one. So we have the two projects, project 1 and project 2. Initial investment, net present value. Okay, so for the profitability index, so net present value divided by initial investment, and this divided by this. Okay, so 7250 divided by 23 million, 7250 divided by 23 million into 100, so the profitability index is the 31.52% for the project 1. And for the project 2, 6750 divided by 16.5 million, so 6750 divided by 16.5 million, so profitability index is the 40.91%. So which profitability index is higher? Obviously, when we compare this and this, when we compare this and this versus this, so higher is better. Higher is better. So we will go with the project 2. Okay, because project 2 has the highest higher profitability index. Okay, so now look at the exam hint. In the examination, you may be asked to calculate the net present value of two alternative project and then to evaluate and recommend. Okay, so this is the same which I have discussed. We know that how to calculate net present value. Okay. Yes, any problem in the profitability index? Okay, everything is fine. Okay, now so we have the case study, fast printing solution. So this is the complete case study. Case study fast printing solution. Okay, so what to do? You have to calculate the payback period, then net present value, and the discount rate is 20%. Third one is the calculate the accounting rate of return. Then there is a in addition to the fact above, so then you have to calculate the payback period, net book value at the 20% of discount rate, then again ARR. Okay, so can you solve this case study as a homework, or may I solve this now? Okay, so you don't know how to do this. So let's read the activity 7. Okay, just read the question, then I'll solve for you. Okay, so just read the question once, then we will solve. Okay, so now read the question and solve this question. Okay, so activity 7. So Fast Printing Solution is a printing company. It was forced to reject a printing order because of insufficient machine capacity. As a result, company investigated the purchase of new printer. Okay, so this would cost 400,000. So this is the cost of the printer machine, but its capacity allows for additional work, 500,000. Okay, so this is the additional cost. The annual cost of running this printer would be, we need two operator, 25,000 each, and the material cost 100,000. Okay, Okay, so calculate the payback period. So we are going to calculate the payback period. Okay, so for the payback period, we know that we need to find the cash flows. Okay. Okay, so for the calculation, we are going to calculate the uh, annual cash inflow. Okay, so what is the annual cash inflow that we will receive? Okay, so the cost of capital will be the cost of machine 400,000, but its capacity allow for additional work of 500,000. The annual cost of running. So this is these two are the annual cost. So where is the inflow? So what is the benefit of the new printer? Oh, I think there is something. There should be the sale given in the question for this printer. So the question is enough. I think so. But it capacity allow for additional work of. Okay, so we are going to remove this line for this. This is the revenue 500,000. The revenue that will earn by incurring the 400,000 cost. So this 500 is the revenue. Okay, so this is our revenue, or you can say the benefit that we will earn from the new printer. Okay, so now we are going to calculate the annual revenue, or you can say the annual benefit by running the printer. Okay, so the benefit will be the annual benefit will be the now calculate this one activity 7. Okay, so the annual benefit, so the annual benefit will be the we are going to calculate the annual benefit. Okay, so okay, so the annual benefit can be calculated by using the total revenue will be the annual benefit will. So total benefit, that is the 500,000. Okay, so less wages. Okay, so wages we have to, because we need two operator, so 25,000 each, so total will be the 2 multiplied 25, so total will be the 50,000 wages. Okay, so 50,000 wages, so it will be the 2 multiplied by 25,000, so 50,000 wages we will pay. Okay, so we have to subtract this, bracket means subtract. And then material, we have to purchase the material of 100,000, so material cost less material cost, less material cost is the 100,000. So now this is the annual benefit that we will earn by using the printer. So 5 minus 150, so that is the 350,000. So 350,000 is the annual inflow. So this is the annual cash inflow. Okay, so now we are going to calculate the payback period. Okay, so for the calculation of payback period, okay, okay, so how many years we are going to operate, oh, so that's years we have to calculate in the payback period form. Okay, okay, so for the calculation of payback period, so here will be the years, then cash flow, then the cumulative cash flow. Cumulative cash flow at the year 0. So there is the investment. So initial investment was, cost is 400,000. So this is the initial cost 400,000. So this is the negative 400,000, and the cumulative cash flow is again 400,000. Okay, and the annual cash flow is 350, but we incur the 50,000. Annual cash flow is 350,000. Okay, so for the year 1, so we will earn 350,000 here. So 350,000 we will write here. So minus 400 plus 350, so answer will be the negative 50,000. Okay, so then is still negative, so we know that in the payback period we reach to the positive values. So the next year we will reach to the positive values, 350,000 next year at the year 2. So then minus 50 plus 350, so answer will be the positive 300,000. Okay, now we are going to the positive values. Okay, so it's mean, so the negative values convert into the positive values from year 1 to year 2. Okay, so now we confirm that the payback period is 1 year plus this divided by this 50,000 divided by 350,000 into 12. So then we get the months. Okay, so this mean that yes, what is the month? Yes, can you do this, all this? 50, yes, 7.4. Okay, 7.14. So it's been 1 year and 7 months. 1 year and 7 month uh, will be the payback period. Okay, so the answer will be the 1 year and 7 month. So the payback period is 1 year and 7 months. Okay, so this means the payback period is more than 1 year but the less than 2 years. Okay, so this is the payback period and this is the answer of part number 1. Okay, so so this is the answer of part 1. Okay, so now move to the part number 2. So part number 2 is the calculate the net present value assuming that the company discount 4 years. Oh, so now discount year is 4 and the discounting percentage is 20%. Okay, so now we calculate. So here is investment, then the uh, discounting rate, and here will be the for net present value amount. Okay. Okay. So for the first heading is the years. So this is the years, and this is the cash flows, and this is the discounting rate at the rate is 10%, and this is the net present value. So first of all, we'll start from the year zero. So cash flow is year zero will be the 400,000. So there will be the no discounting. So net present value will be the 400,000 for the year one. So what is the annual cash flow? So annual cash flow we calculated, that is the 350,000. So 350,000 is the annual cash flow. So for year one, annual cash flow is the 350,000. So now we are going to discount for the 1 year, because we are net present value mean all cash inflows will be at time zero. Okay. So this 350,000 will be discounted for 1 year. Okay, so how to discount this? How to discount it? By applying the discounting formula. So 1 plus 0.2 to raise power minus 1. For 1 year we are going to discount this. Okay, so for the present value, what to do? 350,000 multiply by this factor, then we will get the answer. Yes, can you do this? I am also doing to raise power minus 1. 2 291 So it may be the rounding error, so no problem at all. Yes, so what is the value? Yes, it will be the 291,291,655. Yes, this one. 655. Okay. Okay, so for the year 2, so this is the 350. Then the discounting factor 1 plus 0.2. Now to raise power minus 2 for 2 years, we are going to discount for 2 year before. Yes, so what will be the answer? 243. Okay, 243,040. Okay, so for year 3, again 350,000. Discounting will be the 1.0.2 to raise power minus 3. Answer will be again 545. Now is this correct one? And the year number 4, 350 again. Now discounting at the for 4 year. Yes, what will be the answer? 805. Okay, so now we are going to add all of these minus and plus all of the 4. What will be the final answer? 506,045. Okay, so this is the positive NPV. So if the NPV is positive, so project is profitable. So project is favorable. So we can think about this project. Okay, so this is the answer number 2, NPV. Okay, so it's enough for today. So in the next class we will do the part number 3, then 4, then 5. Okay, then our question uh, will be completed. Okay. Okay, so take yourself.